Welcome, friends. Today we will know how to read a balance sheet. There are two parts in a balance sheet, as the name suggests balance and then sheet. So, two sheets are balanced. One part is shareholders' equity and liabilities, and second part is assets. In balance sheet, both part is always equal. So, how it is equal? Whether shareholders' equity is not a part of asset. If you are looking simply on a terrestrial view, you definitely will have confusion that this should be, or the shareholders' equity money should be part of assets. But if you will see from the perspective of a company in itself a entity, a individual entity, company whatever plant and machinery, money having that are one part is assets. Whereas whatever liability, of course, is a liability, and shareholders' money, whether from promoters or general public or FII, DIs, from wherever they have taken money or whosoever invested is a liability. Whenever company dissolves, this amount required to be returned back to shareholder. Then now it will be clear for you that this is a liability to a company. That is why shareholders' equity is part of liability. And always these two parts are balanced. So assets are equal to all liabilities. In simplified or simple terms, we can say. Then, if we deep dive into liability, then we can see so many aspects of liability. Just now, as discussed, there are two parts. One is shareholder equity, and second is liability. So, what is shareholder equity? Simply, now we have seen assets into is equal to liability. Liability, two part, shareholder equity plus general liability. So shareholder equity is nothing but total assets minus total liability. That will be a shareholder equity. And how much will be shareholder equity? Shareholder equity is equal to face value multiplied by number of shares, number of authorized share or number of total shares. As we are discussing for a couple of days about this Amar Raja battery, there we can see this shareholder equity is 17. Let us see. Here you can see this balance sheet 17 or equity capital 17.08, or you can say as it is crore 17 crore 8 lakh. More exactly, it is 17 crore 8 lakh 10,000. And as face value, you will ask from where I get face value. If you will go scroll up, you will see here face value is 1 rupee. So equity capital will be how much? Face value is 1 into total authorized share. Of course, it is quite clear 17 crore 8 lakh 10,000. So total equity capital is 17 crore 8 lakh. This information we get from here. If face value is 10 and equity capital is 17 crore 8 lakh. In that case, authorized share will be 1 crore 70 lakh 8,000. Yeah. So now, in my view, this is clear for you ki what is equity capital and how much equity capital will be. What is share capital. So this is clear. Now we will see second thing here is reserves. Some place you will see reserves and surplus return. Some places only reserves. So what is reserve? Reserve is a profit parked for special purposes, earmarked for special purposes or some specific purposes. So all those money or kept aside or earmarked aside for specific purposes are known as reserves. Whereas surplus is whatever money unused, not allocated for any purposes, for any instrument, that is surplus. So this is the difference. Now surplus, these reserves are also different type. First is capital reserves. You will find somewhere if you would go through annual report, there you may see first thing is capital reserves. So capital reserves is a long-term reserve company earmark for something. If some projects are supposed to come for that specific purposes, this capital is earmarked. So these long-term reserves are capital reserves. Second coming is securities premium reserves. So above the security value, whatever premium is kept aside, that is securities premium reserves. And maybe some money not assigned or earmarked for specific purposes, but intended to be earmarked for some purposes as and when this is decided or defined. Those surplus or those money kept aside and known as general reserves. Company is expecting some projects to come or they are in process of finalizing, in process of some business development. Once this finalized, then this will be earmarked as per requirement and those money comes under general reserves. Already we have discussed the surplus. Surplus, we can say also a part of a general reserve or maybe totally kept aside. Now we see here borrowings, long-term borrowing, short-term borrowing, lease liability, other borrowings. So all are borrowings. Some amount or some loans or some borrowings are less than for 1 year. That amount we are supposed to pay back. Company is supposed to pay back within 1 year. That will be short-term borrowing. And all money which are supposed to be paid for more than 1 year, that will come under long-term borrowings. For example, company have taken loan for factory building or some assets creation and it is for 10 year or 15 year or so. So this will come under long-term borrowing. Company is taking loan for shorter period that will come under short-term borrowing. For example, if you are buying anything, white goods for your household on credit card, definitely you are supposed to pay within 1 year, maybe for 3 months, 6 months, 9 months. So this will come under short-term borrowing. For the case of company, they are also purchasing some equipment, some machinery that are supposed to be paid within a year. This will come under short-term borrowing. Lease liabilities. Company takes certain things or some services on lease and those liabilities will come under lease liabilities. Maybe some other borrowings that will come under other borrowings, maybe for short term or long term. So these are the borrowings, you can understand. And again, this liability is coming. Trade payables. So company usually purchases materials, those coming under payables. So whatever trade you have, of course you are buying and selling. So whatever you are buying, you are supposed to pay. That will come under trade payables or liabilities. Advance from customers. You have not supplied the goods, intended goods. In the case of here Amar Raja batteries, they have not supplied this battery or set of batteries, but taken advance. So this is a liability. Till the date it is supplied to customer. So that will come under advance from customer. Now other liability items, maybe for any other reason, whatever taken, that will come under other liability apart from trade and advance. So these are the different types of liabilities. Some place you will find current liabilities written and non-current liabilities also. So what is current liability? Current liabilities are those liabilities which are supposed to be paid within 1 year, less than 165 days. Whatever amount to be paid, that will come under current liability. Whatever to be paid beyond 1 year, more than 365 days, that will come under long-term liabilities or non-current liabilities. Some long-term liabilities are like deferred tax liability. Tax every year paid, but due to depreciation, you have computed differently, and income tax may calculate differently. So this may be coming in future. So that tax part is known as deferred tax liability. It may come or that amount is earmarked. So those taxes are deferred tax and will come under non-current liability. Whatever to be paid within 1 year, of course, that will be current liabilities. So these are the part of liabilities side we have discussed. Let us see Amar Raja battery again. We have taken from annual report. In annual report, we will see all these things written here. That is what we have explained from skinner.com. Here, non-current, we will go to first, second part we have discussed. Equity share capital, other equity, other equity, under other equity, it will come surplus and reserve funds. That comes under other equity. So total equity share, as discussed earlier, 17.08 crore, and other equity, all these reserves are 4,534.31 crore. So total equity is 4,551.39 crore. You can see there, you will find same thing. Yes, you can see here reserves and share capital 17, 4,534. And here you can also see 534 total is coming this much. Now here you can see non-current liabilities. Already we have discussed, elaborated financial liabilities, borrowings, lease liabilities, provisions for provisions maybe for employee gratuity, salary encashment, provident fund. So, or maybe other purposes also that that are beyond 1 year that will come under this non-current liability. Deferred tax liability we have already discussed. Other non-current liabilities there. Again, these current liabilities, whatever to be paid within year, financial liability, these borrowings, lease liability, trade payables, provisions, current tax liabilities, other current liability. So these are the things we discussed. In other video, we will see the first part, these assets, we'll discuss in detail all these details. And then third thing, we will see connecting dots between balance sheet and profit and loss account. We'll see in next chapter. This is from this video. If you find some value, please do like this and share with your colleagues and friends so that they can also get benefit out of this. Thank you. Bye bye.